Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what has happened in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Andreas Steno Larsen, who's the founder and CEO of Steno Research, as you can see in the background, and he's also a macro aficionado. So, Andreas, thanks for joining the podcast today.
It's a pleasure to be here.
Really looking forward to that conversation. I guess my first question, I know you've sort of done a recent podcast, the Macro Trading Floor, that you're a co-host on, where you talked about sort of things that you're looking forward to 2023. So I was wondering maybe if you can talk a little bit more about that now, and what are the key trends that you're really watching?
Well, I have five things on my watch list right now. First of all, the Chinese reopening. We've never had a similar setup in China ever in history. So this is the second largest economy in the world, now reopening probably at full steam within 3 to 4 months from now. That is quite the setup, given that we have contradicting trends elsewhere around the globe when it comes to the economic momentum. So from being a clear bear on right about everything, I'm starting to doubt it a little bit, given this Chinese reopening, since it will wreak havoc with right about every trend that we see elsewhere on the globe. So we need to watch what's going on in China, and I'll get back to what you can expect from that reopening. Otherwise, I'm watching the inflation outlook for 23. I've been in the camp for a while now that expects inflation to slow quite rapidly. And I think we have more and more compelling evidence of that. I'm leaning in the direction of inflation closing in on, say, 1 to 2%, so even below target within 6 months from now, which is still a contrarian view. It's not as contrarian as it was 3, 4 months ago, but it goes hand in hand with the recession that we are already amidst in the US and in Europe. I think we've received compelling evidence now that the recession is here. We will obviously not get the bottom line on that question until it's too late. The Statistical Bureau will declare it a recession once it's over. But I think we're amidst one already, which is obviously something you need to consider for your market outlook for 23 as well, especially when you pair it with a reopening of the Chinese economy at the same time. And finally, I'm watching the liquidity outlook. So what do I mean by that? I watch the amount of dollars available to the private banking system on a daily basis, since it is probably the best indicator of future equity performance. And it doesn't look as negative as one could have feared, given the policy of the Federal Reserve. And there are a few technicalities behind that view. But as of now, when I pair all of this, even if we are in a recession, I'm not necessarily too negative on things.
Yeah, that's really interesting. So I guess if we maybe focus on inflation to start with, and that's something that, I guess you're sort of predicting 6-7% decrease in inflation this year, which would be quite a record. Do you think that's just maybe the state that the economy's in, that we're going to experience that? Because it's probably something that we've really never seen before in the past in one year.
Well, let's take a step back and look at why we had inflation in the first case. We've printed truckloads of US dollars, truckloads of euros, truckloads of Japanese yens for a decade, and nothing happened. So this idea of printing money via central bank purchases of assets is not new. So what happened in 2020 and 2021 was that we paired central bank purchases of assets with direct transfers to households and corporates, for that matter. I think that was the reason why we had such a spike in inflation over the course of that period. Obviously paired with supply chains not working due to lockdowns. And if we look at the current status, we've stopped sending money to each and every household. We've stopped sending money to each and every corporate. At least if you look at the US, Europe is a bit of a different beast in that perspective. And we've opened up all economies globally, now even China. So I think on both of these parameters, we are moving in the exact opposite direction of what happened in 2020, at least in the US. And that is to be a material game changer for the outlook. 2020 to 2021 was one of the fastest increases in inflation ever seen. And if we roll back time swiftly on the parameters that made inflation spike over that period, I also expect inflation to wane at the fastest pace that we've ever seen as a consequence of that. So it was a quick spike, and it will be a quick return to normal. But where we go from there will depend a lot on the policy reaction to the downturn that we will see in inflation.
Yeah, because as you mentioned, we've also had the highest rate increase, or the quickest rate increase last year. So do you think we'll see the quickest rate decrease this year potentially as well?
Well, I guess this is already anticipated by many. So if you look at the forward pricing of the dollar yield curve, and look at the spread between the rate in a year from now and the rate in 2 years from now, we have in between 140 and 150 basis points priced in worth of cuts from the Federal Reserve. I have never, ever seen anything like it in my career. So it is very well anticipated that the Fed will start cutting interest rates towards the end of this year, and in particular into next year. So they better do it. Otherwise, I suspect that both equities and bonds will start puking simultaneously again as a consequence of it. So the issue now is to figure out how much of this is priced in already. And even though I lean slightly positive on bonds as a consequence of this cutting cycle coming up, it's not a high conviction of mine to go all in on the trend, given that it is so well anticipated already. Even the turtle economists, as I used to call them, in investment banks now agree that a recession is upcoming. I've never seen such a uniform expectation on growth ahead of a recession ever. So it is quite a weird scenario, and we don't have any anecdotal evidence from history to look at when it comes to such a setup.
Yeah, which makes it very challenging. And then I guess if we go over the pond to Europe, I think it's something where you mentioned where oftentimes they can sort of lag the US, trends. So how do you think this is going to affect Europe as well?
Well, Europe is a different beast, first of all, due to the electricity/energy crisis. We've seen moves and steps towards sending households and corporates money again in Europe to sort of sugarcoat the energy crisis. And thankfully, right now, Mother Nature played ball, which means that energy prices are lower than anticipated a couple of months ago. But it is, if not solely, then mostly driven by extremely hot weather from a seasonal perspective. And that also means that some of the backstop mechanisms being put in place by German authorities, French authorities, etc., they've turned out to be much cheaper than feared, since they've backstopped the price of electricity and natural gas on the top side. And given that the price has faded since, it ends up being cheaper to cover the bill for households and corporates. So ultimately, there is a snowball effect in both directions from an inflation perspective, given such a fiscal policy setup. If prices wane, we will get less fiscal transfers. But if prices start reaccelerating, we will get more fiscal transfers, which may add to the momentum in both directions. So one thing I can guarantee you is that we will have inflation volatility big time in Europe over the coming decade relative to what we've been used to. I think it was in 2019 or early 2020 when I ran the macro strategy team at Nordea, so the biggest Northern European bank. I told our interest rate strategists to find something else to do because the interest rate curve was basically dead and buried in Europe. It felt almost Japanese, the European yield curve, but it's now alive and kicking, and I expect it to be alive and kicking over the next decade as well. simply as a consequence of this inflation volatility. So long macro volatility, long inflation volatility, and right now, only Mother Nature and potentially a meteorologist would be able to tell you where energy prices are going. I think they're headed lower as a consequence of the storage in general being extremely high due to this seasonally hot weather. But I mean, it very much depends on developments in Eastern Europe, and it very much depends on Mother Nature, so it's tricky.
Yeah, I think it was Goldman Sachs potentially said that they actually don't think there's going to be a EU recession, or as one of the big banks, they've actually turned to the thinking it's going to be positive because of the warm weather that we've experienced.
Yeah.
So and yeah, it's quite interesting because you were one of the first people, and I think you got a lot of criticism for saying that the energy issue might not be as bad as everyone thought in EU. So I was wondering if you could maybe talk about that more, and I guess is the main key the storage here, and is that sort of why you think it might be okay going forward?
Well, let's take a step back and look at what happened last year in energy prices in Europe. We had this tremendous spike in natural gas prices and electricity prices from June until early September. I think, first of all, it was driven by political decisions. So the European Commission decided to dictate trends across all member countries by telling member countries to ramp up storages of natural gas over the summer while the taps were still open from Russia. And it basically meant that all European countries started buying natural gas at the same time. And it is not a typical season to buy natural gas with an arm and a leg, which made the spot price go bananas. So I always consider it a false flag when the price started accelerating as much as it did last summer, because it was just extraordinary from a seasonal perspective to see that amount of buying over summer. What ultimately happened was that storages were filled up ahead of schedule, since everyone bought ahead of schedule. And when we reached the heating season, we basically entered that season with record high storages across the European Union as a consequence of that early buying. And when you pair that with a couple of months of extraordinarily high temperatures, we're now standing in early January with almost full storages across the Union still, with, say, in between 2.5 and 3 months worth of the heating season left. So, I mean, this year is obviously safe. The big question is now what's going to happen next winter. If we look at the daily data on natural gas flows to Europe, we've obviously removed the biggest supplier. I don't know whether I hold the view that it's our own fault, but at least we've decided not to buy natural gas from our biggest supplier, Russia, anymore, which means that we need to find new suppliers, because the daily inflow of natural gas is in between 25 and 30% lower on any given day in Europe. And you cannot replace 30% of the natural gas consumption in Europe on a time horizon of 1 to 2 years. It's more or less impossible. You can replace some of it by moving to, for example, coal in the electricity production. But for district heating, natural gas is typically the main source. And as soon as you start bidding up other sources, they become expensive as well. We've seen that with the price of coal, with the price of heating oil, etc., in Europe as well. So we need to look for new suppliers. And in light of that, it's quite interesting to see the criticism of the World Cup in Qatar, especially from European countries, since, for example, the German administration traveled to Qatar while the World Cup was live to strike a new deal on natural gas deliveries. I think they strike that deal less than 24 hours after the German soccer team, they were standing with their hand in front of their mouth on the group picture for the opening match. So Qatar is a place to go to find new supply. The US is clearly a place to go to find new supply. I basically consider the US to be the Middle East of natural gas. you've got plenty of natural gas. The question is just to find ways to set up the infrastructure to export it to Europe, since you obviously need shipping facilities, you need LNG cargo ships to a much larger extent than what we've seen already, and you also need infrastructure being built on the receiving end in Europe. And I guess that is the lifesaver right now for Europe, to build LNG facilities in Germany, in the Netherlands, etc., to receive more natural gas from the US, from Qatar, from Australia this year. And we've managed to replace, I'd say, in between 60 and 65% of the flows that we've lost with new liquid natural gas, but it doesn't add up still. And that is why I'm still certain that we're in a recession in Europe, because if you decrease the consumption of natural gas, it essentially means that you decrease production. Natural gas is a production input in many industrial companies in Germany, Poland, and elsewhere. And we can see now that the natural gas consumption is down 25%-ish in households and in industrial clients across most of the industrialized Europe. So that means to me that at least the industrial output is waning, and it's shrinking quite fast. And therefore, I mean, we've been able to cope with it. We've been able to bring prices down, also with help from Mother Nature. But as the price that we've paid has been high, and the recession is here as a consequence of it.
And do you think it'll sort of follow us? So I know energy is quite different. Do you see it being that the EU central bank will be under pressure to sort of cut rates as well? Or
here's the deal, right? They ultimately ended up viewing this inflation pressure in Europe differently than what they did 2-3 quarters ago. Even if the inflation pressure is pretty clearly linked to this energy crisis. And if you start hiking interest rates rapidly as a consequence of an energy supply crisis, I guess you need to cut them rapidly again if the supply crisis is over. So yes, ultimately, they will end up in a cutting cycle, but with a quite substantial time lag to the Federal Reserve, I guess. Also, given that the pressure from energy has been so immense that it's now starting to show up in wage data. It's starting to show up in core service data, in inflation numbers in Europe, with a substantial time lag to the actual increase in the energy price. So I think we need to wait until the second half of this year to see any meaningful downturn in European inflation relative to what we will see in the US this quarter. So it is ultimately very tricky to handle such a situation for a central bank, right? We have our offices in the same buildings as some of the big unions in Scandinavia. And they all say the same thing ahead of the negotiations for wages this spring. We need to be compensated for these high energy prices. It's not our fault. And I mean, I understand why they hold that view. So the focal point now is whether they have bargaining power ahead of these negotiations, and I think they have, which means that core inflation will be quite tricky to kill this spring for the European Central Bank. So yes, the European Central Bank will keep hiking for the time being.
Yeah, definitely. I'm based in the UK, and we've definitely experienced what the unions can do, especially linking to CPI and high energy prices and how they should be recompensated. So, if we go over to China, you mentioned there are other trends with the reopening. Do you see that that's a potential risk as well? That they're reopening, they're obviously going to need more energy and more commodities. Do you think that could be further maybe exacerbate the inflation issue, or is that maybe a red herring?
It's a tricky equation, since a Chinese reopening holds both disinflationary trends and inflationary trends at the same time. So from a supply chain perspective, it's disinflationary that China reopens. From an energy consumption perspective, it's inflationary due to energy demand being brought online again. But I had a look at the inventory data in China ahead of the reopening, and gasoline inventories are booming. So I basically think that they bought ahead of this reopening, at least in energy terms. It is less clear whether they bought industrial metals ahead of this reopening to the same extent. So, for example, copper inventories are not as booming as energy inventories are. And I think it was just this week, China announced that they will allow for a bigger export quota of refined oil products, which to me is a clear signal that they have more gasoline than they need for now. So I think there are two time horizons in this. I'm not buying the story that energy will spike like crazy because of this reopening short term, but obviously it brings demand online over the longer term. But as of now, I'm short energy, both due to these inventories booming in China, but also given the seasonally hot weather and the booming storages elsewhere.
Yeah, it's really interesting. So, and I guess, you mentioned that there's actually the third point was US liquidity and how there's probably more in the system than otherwise thought. And you can say that China as well, they're looking to provide a little bit more liquidity into the market. So that combination could, do you see that? It maybe in the short term could be bullish for the stock market?
Yeah, I wouldn't rule that out. I mean, I've told our clients to enter this year with a positive tilt in equity markets. So far, so good. And it sounds counterintuitive when we are already in a recession, if I'm right on that view at least. But the reason is that liquidity is holding up better than feared due to a few technicalities, and then we add the Chinese liquidity on top of that. But if we look at the dollar liquidity equation, allow me to become a bit technical here, because what happens currently is that the US Treasury slowly but surely brings down the amount of US dollars that they hold on an account at the Federal Reserve. So the US Treasury has its own account at the Fed with billions and billions and billions of US dollars. A US dollar created by the Federal Reserve can either be parked at a private bank deposit or at a deposit held by the US Treasury at the Federal Reserve. So either the US Treasury holds the dollar or the private banking system holds the dollar. And right now, when the US Treasury empties this cash balance, they allow the private banking system to be on the receiving end of all of these dollars. And when Wells Fargo, Bank of America, etc., they receive these US dollars, they hold a larger cash buffer per se. And that typically means that they increase their risk taking since they have a larger cash buffer. And we've seen quite a decent correlation between the S&P 500 and the net liquidity developments in US dollars. Right now, we still don't know the exact timing of when the US debt ceiling will be hit, but we know that it is an issue for, say, the next 5 to 6 months. And it's basically a political decision that's been taken a few years back, that every time the dollar debt ceiling deadline looms, the US Treasury is forced to bring down the amount of cash that they hold at the Federal Reserve ahead of that deadline, to ensure that they don't incentivize politicians to basically drag out negotiations for months after months. And that is a very material trend in dollar liquidity terms relative to what we see from the Federal Reserve. Because if the US Treasury adds, say, in between $300 and $350 billion over the course of the next 3 to 4 months, then the complete effect of the QT withdrawal of US dollars will be annulled via this technical trend. So from a liquidity perspective, I think we should be decently upbeat, at least for February and March. April onwards looks slightly more troublesome.
So then once they, I guess, increase the debt ceiling, which you'd assume they'd have to, does the treasury then sort of, I guess, rebuild that liquidity that they have? How does
Yeah,
that work? Yeah.
yeah. So typically they aim at in between 700 and 800 billion on this account. They are currently stuck with right around 450 billion. So they can bring that amount down to sub 100 billion. And then when they rebuild it again, they will basically withdraw, say, 600 to 700 billion from the private banking system, typically very swiftly, which is a negative for equity markets.
Yeah, and if you think about it, next 4, 5, 6 months, there was going to be QT as well, you'd assume. Plus, there's going to be this big spike. So it could be over close more than $1 trillion withdrawn from markets.
Yeah, it adds up when you look at QT plus this technical effect from the Treasury General Account at the Fed. And I mean, that's why ultimately equity markets will likely have to suffer more. I just don't buy the timing that it is right now. I see that most investment banks predict higher equities by year end, or at least flat lining equities, but they expect equities to suffer this quarter before rebounding into the second half of the year. And my take is basically to turn that picture upside down.
So later, do you sort of buy the picture as well that we need unemployment to increase? So is that going to be, I guess, from your perspective, the key driver to then once unemployment increases, then the Fed might start thinking of, pausing or even reducing interest rates?
Sure, but that's not necessarily a buy signal. And let me try and explain why. I mean, since, as I mentioned initially, that this is one of the most well-announced recessions ever in history, we also have a very uniform positioning among investment professionals. If you ask money managers and asset managers on a monthly basis to assess whether they are long or short equities relative to their benchmark, they all tell you that they're short equities relative to benchmark already now. So who's left to sell when all of the professionals are short already? Well, what they cannot control is the inflows and outflows from their clients. And if we start to see a rising unemployment rate, you typically start to see outflows from asset managers and fund managers as a consequence of regular people withdrawing money to ensure that they have the savings, etc., in place to help with monthly bills. And that is the very brutal mechanical way that a recession creates a sell-off in equity markets. So the bottom in equity markets is typically found in between 6 and 12 months after the recession starts. And the reason is that regular people withdraw money from asset managers when they need them. And the asset managers are not in control of that. So even though they think equity is already cheap, they will have to sell more equities if the withdrawals start.
Yeah, it's really interesting. I guess, do you also see there's a potential because, obviously there's lots of international investment in the US markets. If international investors start maybe withdrawing back to their countries as well, that could also have an impact on the dollar going forward.
Yeah, I mean, it's kind of an interesting backdrop for the US dollar, given that savings are to a large extent parked in US dollars. We've seen nations such as Germany and Japan on a running basis increase their holdings of US dollar assets due to large current account surpluses that they need to place somewhere. And right now, both Japan and Germany have almost no current account surpluses to cheer about. They are even closing in on current account deficits, right? And that is a game changer to that overall dollar allocation story. I also think the Chinese reopening is a positive for the euro relative to the US dollar, simply due to the fact that China is a bigger trading partner of Europe relative to the US. And it is essentially the same view that holds across various regions. You find very few countries that trade more with the US than China right now, which to me means that a Chinese boost to the economy should lead to a dollar sell-off, broadly speaking, maybe except for against Latin American currencies.
It's really interesting. So I guess, you've mentioned those three trends and we've talked about them quite a bit. Is there any trend that maybe you're not sold on yet, but you think could be an issue going forward?
Well, I guess what I fear the most is some kind of highly volatile inflation scenario for the next decade. And I mean, it's tricky enough to forecast the next month of inflation. So starting to forecast 10 years of inflation is probably just idiotic. But I've seen quite a few macro pundits trying to sort of use historical analogies in inflation terms. Is this type of inflation similar to what happened in the 1970s? Or is it rather a warlike post-World War II inflation scenario? I don't know, really. This is a combination of a war and a supply-side crisis in energy. So I guess it holds similarities to both the inflation outlook that we had after the Second World War and the inflation outlook of the 70s. But one thing I've noted when studying inflation cycles throughout the past 200 years, basically, and Bank of England is a tremendous database when you want to assess inflation trends over the course of more than a couple of hundred years, because they actually have the data. Then one thing is certain: it is unlikely that inflation will not resurface once it's been as violent as it has this time around again. So as soon as we have a spike, say above 6 to 7% in inflation, we don't have any historical evidence of inflation just fading and staying low. But we have a lot of historical occurrences of inflation resurfacing in a double top. So that's what I fear the most for the next decade, that we will see extreme interest rate volatility and extreme inflation volatility due to some of the dynamics beneath the surface in the economy when it comes to inflation.
And what would, I guess, you need to see to then think, okay, this is the path we're going on?
Well, what I'm basically on recession watch in this discussion. And I said during 2020 and into 2021 that as soon as you introduce direct transfers as a crisis instrument, it becomes very, very hard to just remove that tool from the toolbox again. In democracies, voters will ask to be compensated if they know that the instrument is available. And since we are staring directly into this recession, higher unemployment, etc., I wouldn't be surprised to see more or less de facto universal basic income resurfacing as a tool. And as soon as you get that announcement, say from the Biden administration, that they will start sending checks to each and every household again, if they do that, then you better run for the hills, because it will likely lead to inflation resurfacing. It will likely lead to mayhem in the long end of the dollar yield curve again, at least unless the Fed decides to control it, as the Bank of England has done in the UK. So that's what I'm on the watch for. If we get direct transfers back in fashion already during this year, then I feel very, very certain calling for this double top in inflation.
I guess then you'd want to be long AMC and maybe other high beta assets. but yeah, so Andreas, thanks so much for your time. I really appreciate the insights you've offered. So I guess my last question is, what is one message you want people to take away from our conversation?
Well, for now, there is no reason to be as negative as the consensus. Right about every portfolio manager I speak to is negative. right about every investment bank that I speak to is negative. And I think it will be wrong-footed both due to the Chinese reopening, but also due to the liquidity outlook, at least for January, February, and March. We will probably have a negative spike in sentiment after that. But for now, the sentiment is too negative.
Yeah, so it might take longer than everyone's expecting. Perfect, Andreas. Thanks again. So, if anyone wanted to find more about your work, I know you're all over social media. You got your own podcast, and obviously the research in the back. Where would the best places for that be?
You can find me on stenoresearch.com, and I'm happy to share a discount code with the audience. We've launched probably the best European macro coverage out there, and we try to make it affordable. So it is not as expensive as buying research from investment banks, not at all. Otherwise, you can find me on Twitter at Andreas Steno, so just my name. And I also host podcasts and video shows both at Real Vision and at Blockworks. So you can find the macro trading flow in each and every podcast app, or go to realvision.com to watch our shows. So I guess that was the short version of a very long story.
Yeah, exactly. I'll put that on the description below. So, Andreas, thanks again.
Thank you, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.